The economics just don't work in proof of stake. We have no way of really incentivizing decentralization, and then it always naturally consolidates to the biggest players that have the most resources, because there's no on-chain mechanism to really incentivize smaller validators, because you can't prove that a small validator is only run by one person.
But it's still a massive opportunity. Like, there's just Bitcoin lying there that you can borrow at that like low cost.
The percent of the crypto market cap that's secured by proof of work and then by proof of stake. And I had done this slide before in presentations. A year ago, 32% was secured by proof of stake, and now it was like 20%. We see just a huge amount of assets are struggling. I mean, all the growth came from new networks to a large extent, right? New networks and of course price growth as well to some extent. Both of those have not performed so well, right? So you basically have an industry that hasn't been growing much or even shrinking.
If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on Eigenlayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
This episode is proudly brought to you by Gnosis, a collective dedicated to advancing a decentralized future. Gnosis leads innovation with Circles, Gnosis Pay, and Metri, reshaping open banking and money. With Hashi and Gnosis VPN, they're building a more resilient, privacy-focused internet. If you're looking for an L1 to launch your project, Gnosis Chain offers the same development environment as Ethereum with lower transaction fees. It's supported by over 200,000 validators, making Gnosis Chain a reliable and credibly neutral foundation for your applications. Gnosis DAO drives Gnosis governance, where every voice matters. Join the Gnosis community in the Gnosis DAO forum today. Deploy on the EVM-compatible Gnosis Chain or secure the network with just one GNO and affordable hardware. Start your decentralization journey today at gnosis.io.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Sebastian Couture, and I'm here with
Brian Crane.
Hey, Brian. What's up?
Hey.
You look wide awake.
Yeah, I'm highly awake.
It's very early here on day 2 of Staking Summit, and we're joined by none other than Mirko. Yeah, man. All good. Yeah, and
Toby.
And so this is the 4th Staking Summit, 5th Staking Summit. Yeah. Or you can say the 5th if you count like the first rooftop meetup in Lisbon, which is 20 people. But yeah, it's the 4th real one.
Okay. And Mirko is the one who created it all.
Very impressive. Yeah, it's a team effort, obviously. Yeah. So I've been to 3, and I thought all of them were really good. But this one is like pretty big compared to say like the one you had in Bangkok. That's the last time we talked. And I think this conversation will be like a good kickoff point from that last conversation in November, where we talked a lot about meme coins, which are not in the like not a thing anymore. But also, Bitcoin restaking and Bitcoin staking and Symbiotic had not gone live yet. So I think there's a few things we can sort of pick up on. But overall, what has been your what's been the main thing that people have been talking about here at the conference?
I think it's really about Bitcoin staking has evolved. The narrative is more about like sustainability now. So everything is more back to the fundamentals, I feel. It's not about just hyped up. It's more about, okay, how can we actually create sustainable yield at the moment? And I think we have to do a lot of work there. It's the same with like shared security. It's also evolving more and more and going in the direction of like, okay, how do we create actual use cases for staking and not just repurpose economic security, which no one needs, maybe.
So it's going to pay for.
Yeah.
I mean, I think what's an interesting thing to look at, just how this is, to illustrate how this is not working at all today, is if you look at Aave, is around $4 billion worth of Bitcoin that's deposited in Aave at a deposit rate of like 0%, literally, or like 0.03% something. the amount, and you can borrow Bitcoin on Aave for like 0.5% interest, so it's very, very cheap. But only like 10% of all the Bitcoin that's being deposited is being borrowed. So like there's basically almost no demand, right, for people who to even borrow, at 0.5% interest. And obviously, if you could earn yield on Bitcoin in any meaningful way, people would do this, right? They would be borrowing Bitcoin, but no one's doing it. So I think you can see that kind of like we're just very, very far. There's like a bunch of points and airdrops and stuff people can get, but I think we've all seen those. I think the times where you can make a ton of money from like point farming doesn't seem to be the case right now. So yeah, I think it's going to be a hard road to get like staking yield to Bitcoin.
Yeah, yesterday we also had a panel with the Lombard guy on it, and he also mentioned something similar. People want to hold on to Bitcoin, and there are just not yet enough sustainable yield opportunities in the space, so they are comfortable even putting it into such an Aave contract where they're just earning such small amounts of basically that's nothing. Exactly. So there's just a state of
The only reason why you put it into the Aave contract is because then you can borrow against it, right?
You can take leverage, like
you can take leverage,
borrows and sales,
right? So, but then you're not earning yield on Bitcoin.
Yeah. But I think people don't necessarily need the yield, so I guess it could even scale way higher than the 4 billion that we have right now, because there's an infinite demand for leverage as well in crypto, right?
Well, not infinite, right?
It's not infinite.
It's 4 billion.
Or something like once we get back into the bull market, it will increase. That's far.
Yeah.
But it's still a massive opportunity. Like there's just Bitcoin lying there that you can borrow at that like low cost. So if you are able to, structure a product around it or arbitrage in some kind of way, I feel like this market.
Sure, but you can also say, oh, there's I don't know how many trillions of gold, and like no one's earning yield on gold. If you convey yield on gold, it's a massive opportunity. Like, sure.
Tether just bought like $2 billion of like gold reserves, right, for the XAUT token.
Yeah.
So I wonder what they are cooking as well. What do you think is the opportunity here with regards to Bitcoin? I mean, like if you think about it, this Bitcoin is not being utilized, it's not being borrowed. So there's like all this Bitcoin that's just sitting there. Is this sort of a bearish sentiment on Bitcoin, or people are not longing it, or like borrowing against it to like sort of loop or leverage?
There's no bearish Bitcoin at all. People just like Bitcoin, and there's not much else to do with it.
Yeah,
to Bitcoin.
I also think like the market is still maturing. It used to be a hodl asset for a long time, and now it's like people are building opportunities around it.
Yeah, I think it's about unlocking even more utility for Bitcoin now and finding like interesting use cases. So we're working on this Loop BTC product, for example, where we're looking to like source from RWA yields and then arbitrage with the like 0.5 from Aave. And then it can create like a really interesting basically like lending out BTC to market makers, and then you can earn like a fixed income on it for like 5 to 6%, and then you can arbitrage that with the lending markets where you get it for 0.5. So when you loop that, you can go to like 15% plus in very sustainable APY.
How can you loop? So wait, I'm giving my Bitcoin to some market maker. Which is always it's an under-collateralized loan.
It's collateralized loans.
It's collateralized. Or so, what would they put up as collateral?
I mean, this is I think they would have to figure it out like in the details, but they're working with like big OTC desks in New York, and figuring out the details how to source these RWA yields. It's a product that's still relatively early in the development, but there's huge demand for people that are doing the basis trade with Bitcoin basically, so they can generate like a very good yield on BTC, and then they can earn or like pay 7 to 8% on it, I think. in fixed income.
I think the idea would be to collateralize the NBTC token, right? And then borrow wrap BTC against it.
NBTC?
Wrap WBTC.
Yeah, so the RWA yield will be sourced or like will be tokenized in a NBTC token, and that can then be arbitraged with the wrap BTC. So you basically tokenize the RWA yield.
Oh, so you token RWA yield? You mean the thing that the OTC desk pays you?
Right. Yeah.
Right. So the OTC desk gives like whatever, it makes up some coin, and then you put that in a pool and borrow WBTC against.
Yeah. So you deposit BTC or wrap BTC in a contract. They take that BTC, lend it out to a market maker, form the basis trade, and generate
And
the
they
yield.
put RWA stuff as collateral.
Yeah.
Yeah.
I mean, the BTC is still there, right? So,
And how is the BTC? I mean, if the market maker presumably needs to use it, right, for trading.
right. Yeah. But they have the like the position is still there. It's not going anywhere.
But you don't know that, right?
Well, yeah. I mean, this is the
It's like the position's still there when you lend to 3 arrows too, right? Like,
yeah, but it's all transparent, and they work with like big trading desks and so on. So, this is more about, I think the idea is to create a product that sources from like off-chain yields, where there's so much opportunity in the market right now, and the more we can like bridge this gap between TradFi and DeFi, I think this poses like so many possibilities. If we do that like in a transparent way, and obviously have like good security and transparency measures in place.
one kind of actually, I think potentially sustainable way of earning yield on Bitcoin, is you put Bitcoin into Aave or something like that, and you borrow stablecoins against it, which, I think costs you 4 or 5% or something. And then you use those to earn a higher yield. Like maybe you can earn 10% on the stablecoin, right? Like that seems pretty doable. And then you could sell off the difference with Bitcoin.
Yeah, it just depends for what risk can you earn the 10%, right?
Yeah, sure.
Yeah, I like that.
Yeah.
It's you should build that as a product.
Yeah.
But that's the thing, there's just like so many opportunities on Bitcoin, and I think the space has to evolve more towards things that pay like real yields and not just staking, where obviously in staking the yield continues going down, I think, over time, and it will be hard to source very sustainable yield just from inflation rewards, obviously.
So for you, Mirko, you're also focusing a bit more on Bitcoin now with this.
Yeah,
That's kind of a big focus for you.
Bitcoin, I mean, I've been excited about Bitcoin for a long time. And I think having a sustainable yield product on Bitcoin, it's a huge opportunity. And we are creating this product that we are still scoping out and the final details and so on. But we see this as something that can, really help to unlock like the next big wave of BTC staking and sustainable yields, basically.
And so you guys are also going from, because so far it's kind of like data and events to more like yield products, creating yield products.
Yeah. So the idea is to create products like looping products. And we've tried that with Loop Type now, and it was pretty good. We launched it like 1 month ago, have like 20 million TVL in it now. And the great thing, it's like fully complementary to all the validators. We work with validators with this community code structure. So if the validators deposit into the vault, we make sure that like all the stake is looped into their validator position.
Are you using ST Hype?
Yes. Yeah.
What's ST Hype?
Thunderhead guys.
Yeah.
Like a small team that's been like a lot of different liquid stake
And privacy. Yeah. And they have this feature, community codes, where validators onboard, and if someone uses the validator's community code, then the underlying stake is entirely attributed only to this validator, basically. And when we then we also introduce this community codes for the looping product. So we have a community code, and then we make sure that the underlying stake is entirely looped with this validator.
Maybe to loop this back to why Bitcoin, what we are seeing, for example, with staking, I think you guys are seeing it as well at Chorus. Stake tends to be quite sticky. So when is the opportunity the biggest? It's in the beginning of either a network launch, right, when nothing is staked yet. So you really want to penetrate the market really early, become a big ecosystem player. And try to get that initial stake, because it really tends to stick to your validator, liquid staking protocol, or DeFi protocol. And then going back to Bitcoin, it looks like this opportunity seems very similar to a new network launch, because right now we have, like, Bitcoin is just lying around on so many wallets, so it's not really staked and it's not really sticky to a specific yield opportunity yet. So being early in this market and providing a great sustainable yield opportunity to get this initial deposit and sticky stake happen is right now a big focus at Staking Rewards, and that's why we're also shifting our looping product focus into this direction.
Yeah, so there's a high stickiness to Bitcoin being deployed into various like yield generation products.
There's, generally speaking, a high stickiness in staking. So once you are staking, you're just not thinking about it anymore, because in your head you're thinking, yes, this is like now a productive asset. I'm just earning my passive yield. I do not need to switch it. It's a cost to switch it again. You need to make more research, right? So if you're just providing a really good sustainable product out of the go, where people can put it, right? If you get this initial transaction, others will have to make big investments also to move like staked BTC from potential depositors. So the opportunity in the beginning is the highest, and the market is right now maturing and developing. So you want to be part of it.
Yeah, I wanted to talk a little bit about the maturation of the staking market a little bit, and I'm glad that you're here. Yesterday there was this talk on M&A in the staking ecosystem. I don't know if you saw it.
I missed it. I mean, I've talked with JP a bit about it, but I unfortunately missed it.
Yeah, I mean, JP, you've also done some acquisitions in the staking ecosystem. I was also talking to Laszlo yesterday from Kiln, and we were discussing sort of consolidation in the staking ecosystem and what the future might look like. And it seems like, there are a lot of indications that the staking ecosystem, as it matures, will consolidate, and that many staking providers, will either get acquired or will acquire smaller staking providers. And so I'm curious, what you all think that the staking ecosystem might look like in 5 to 10 years. Right now it's quite decentralized, I'd say, and like there is a wide range of types of actors, from home stakers to kind of ecosystem community partners to large institutional providers like Chorus and likes of Kiln and Figment, etc. So what are your thoughts on sort of how the staking ecosystem emerges from here, and like what is the role of, say, asset managers, exchanges, neobanks in this in the long term?
Yeah, I mean, so I did a talk yesterday, and I included this slide which had the percent of the crypto market cap that's secured by proof of work and then by proof of stake. And I had done this slide before in presentations, but then it was interesting to see the data again, because I checked, and it was like a year ago, 32% was secured by proof of stake of in the, the rest is mostly Bitcoin, right? And now it was like 20%. Right, so we've seen a big. I mean, we see just a huge amount of assets are struggling, and you have some that are thriving. I mean, Solana is doing pretty okay, and Sui, and there's like a few, but even Ethereum struggling, and but then the long tail of assets really struggling, right? So you have basically. Some pockets of crypto doing well. I think mainly Bitcoin and stable coins, maybe. But a lot of it is not. And of course, staking, I mean, all the growth came from new networks to a large extent, right? New networks and of course price growth as well to some extent. But both of those have not performed so well, right? So you basically have an industry that's kind of hasn't been growing much now, or even shrinking. Now, what would it take for that to change, right? I mean, you maybe would have to see. I mean, of course, you could have some temporary change, or some change just in the price side, which will of course be great for existing players. It would still make it hard for someone new to really come in and benefit much. I think for new people, new companies to come in, you'd have to see maybe really a lot of new networks launching again that like actually get a lot of traction, and I don't think that's going to happen anytime soon. Like, I don't think it will happen in the next 2 years. Like, we see fewer new big network launches, when we look at like, I mean, okay,
2021, 2022.
yeah, I mean, if you look at like our thing, of course, there's a variety of networks that we're going to launch, but of like really high expectation ones, I mean, Monad comes to mind. Then there's like not that much else. So I think that's just, and then you've had in staking, you've had an industry that was very easy to enter, right? Like the initial barrier to entry is very low.
Yeah.
So a lot of companies came in, and then you have kind of this, huge supply of companies, and you have an industry that's been kind of shrinking a bit for a while. And of course, that's a very challenging situation. It means a lot of companies are, not in a great position, or like and so, yeah, I think some kind of degree of, and then some other things, right? So new networks have tended to have smaller validator sets at launch, right? So, maybe 10 or 15 or 30 or something like that. So even then, just getting in is like harder. And then you've also had the thing where now some networks are saying, oh, maybe investors cannot stake, or maybe there's lower staking rewards,
Or there's no staking rewards.
or no staking rewards, right? Or like all the staking rewards are locked, or like they do all this stuff, which I think is a little bit desperate and doesn't make too much sense if you ask me. But it's kind of like this reaction of like, oh, I mean, we're afraid, right? We're afraid of the market. We're afraid there's no buying demand. So we try to kind of like cut off all the sell pressure. But of course, that is also reduces the ability for staking companies to generate revenues. So yeah, I think all of these make it challenging. And then at the same time, I think the integration into wallets, fintechs, TradFi, ETPs, all of those things becomes more important, and I think that's expensive to compete in.
Right.
Because you have to invest a lot in product, you have to invest a lot in BD and compliance and brand. There's a lot of things you have to invest in a lot. So I do think that you can have a situation where, there's only a handful of companies that, can really compete there, and they can do okay. None of them are going to do like amazing until things change, right? Until maybe the market changes. But then I think a lot of others are just, they don't really have a very viable business, right? So then we've also seen, right, a bunch of, you mentioned, M&A and stuff, right? So we have seen some of those. We haven't really seen any large staking acquisitions, right, for a while, but we've seen a bunch of small or kind of struggling ones sell more recently.
Yeah. Yeah, that's a great overview. I mean, sorry. Go.
Yeah, I just want to say, I think obviously it's going, or there would have to be much more differentiators for stake price. It's becoming much more important to have an edge, I think. And I'm not sure how many edges you think there are, but I think there's probably at least 3. Either you have like very good distribution as an edge, or you have like the geography can be an edge. If you can be like the leader in a certain country and maybe also like, claim that market and have like good contact with regulators or whatever. Or it's like the third edge would probably be like strategic. That's what you said. Like a lot of networks are just launched with a small set, and they're just bringing people on that are like fully aligned and strategically helping the product grow as well. So it's not necessarily about like generating rewards or for them to set it up as a business, but it's more, okay, they already use the product and they have to grow. Maybe they are invested themselves in some form or another. And then they also run a validator for it, basically. So it's like either distribution, strategy, or geography.
Yeah, I would also say the validator meta has changed completely. Like if you were like a top 5, like competing with other top 5 validators, maybe 3 to 5 years ago for like a slot in the network what is just launching, compared to now where you're competing maybe with 20, 25 to 30 or even more providers, because everybody is just improving. And on the infrastructure level itself, I would say the difference in performance is very little. So you have a lot of providers in the space that are very, very similar when it comes to the infrastructure, basically what is important to secure a network. And you really, to build on Mirko's point, you really need to differentiate. And you also really need to probably do some very calculated bets on networks that you deem to be winners, right? Because in order to get into the active sets, you need to offer some additional services, maybe some value-added services, or somehow add value to the ecosystem, because just infrastructure, I feel like, is not enough anymore. And I also strongly believe that it won't be enough in the future. Otherwise, you just like be competing over price and then basically running the infrastructure for free.
You think the infrastructure then just basically gets commoditized and validators are basically only competing on price? Like,
I mean, or they have
some strategic.
Yeah, exactly. Yeah.
I think that's probably the case for like the basic infrastructure provision. But there's also the case, I think, where staking itself will become more specialized into like performing certain tasks and actions. So, for example, like in BitTensor, it's a totally different ecosystem, but to run a validator on BitTensor, you actually need to set up like a real data center. You need to like really perform some work. Like you need to do this, what is it called that they do in BitTensor? But they basically validate these subnets, and they perform like all these AI models running basically as a validator. So it's an actual task that creates value as well. It's more like, it's going more back in the direction of proof of work, maybe, where you perform not just stake, but it's a bit more work. And I think there will be more use cases as well, probably on the infrastructure side.
I think there can be, I mean, we have a sort of small like quant research team, and we have gone like sometimes we go very deep on some networks to optimize performance and rewards, which can make a meaningful difference. But it tends to be, first of all, on a lot of networks, you can't, there's really not much to do. And on other networks, it's not worth doing anything, right? So then it's really like, I mean, right now our effort on that front is, just focused on Solana and Berachain a bit. And Berachain also, there's actually very, like, the difference for us in the rewards we've been earning on the BGT proof liquidity thing it's actually very meaningful, right? So that's a big difference between like, so we spend a lot of time, some optimizing that. And Solana, I think there's also meaningful differences you can achieve, but then it takes a lot of work, right? Because you have to really dive into it, and you have to research it and understand it, and then maybe you start modifying the client. So, but I think that can be, there can be meaningful differentiation there, but you have to go very deep, and of course that's expensive, takes a lot of resources.
Yeah, you guys recently cut a couple of networks that you were
Yeah, we
So-
caught like this was the biggest network.
How many networks?
I think like 15 or something.
Oh wow, that's a lot.
Wow.
Out of what? G60?
Yeah, we were like I think running around 6, maybe over 60. So I think now we will go down more to like 50. I mean, we're still in the like the whole offboarding thing takes a bit of time too.
Yeah.
I think we'll probably do another round like afterwards. Look at maybe a few more networks.
So is it just a profitability question there, or are there other things that come into?
Yeah, it's profitability mainly. Yeah, it's there's just a lot of networks where just the token was doing poorly, and maybe also the economics were not very good, and we were just not making any money, and there didn't seem to be any prospect to get to. Yeah, so I mean, I think for us, it's it's definitely a part of wanting to focus also more on the big networks that make a big difference.
Right. This kind of comes back to my earlier point about consolidation. So it looks like you guys are consolidating on the bigger networks, and there's like consolidations at different level, right? There's like consolidation of say at the broader level of the ecosystem of stake within a certain number of very professional actors that have distribution. There's also consolidation at the individual provider level where you're consolidating, like those large actors are going to want to consolidate around big networks that have profitability where like token price is going to be maintained. And so it kind of feels like, and then consolidation also at the network level where, those large networks may launch with smaller validator sets in order to like prevent too much inflation of the token, in order to prevent like the sell pressure, et cetera. So like, there's consolidation at every level, basically. Does all of this picture together, does it just point to a world where there's like networks are less decentralized, where there are fewer validators on each network, and fewer large validators, or sort of meaningful, sort of enterprise grade validators, securing most of the ecosystem?
Yeah, I think so. Absolutely. Now, I think there's different reasons for it, right? One is that the decentralization is, it's kind of expensive, right? It's expensive to pay a lot of validators enough so that, it makes sense to track if them come in. And with token prices not doing well, new networks struggling, right? People are like, I want to like save that cost. And then I think the other thing is that people just don't care that much about decentralization, right? But people don't care much is like 200 validators or 30 validators, or like it doesn't really seem something that's like a huge determinant of success. So then people are like, well, we can, this is a place where we can save cost.
That's sort of an existential crisis sort of question, isn't it? Because I think the entire point of the industry, the entire point of blockchains broadly is decentralization and no centralized control. It's sort of, I think the economics just don't work in proof of stake as well. Like we have no way of really incentivizing decentralization as well. There's no economic lever for someone that's running a small validator, and like if there are like a lot of protocols have tried, I guess, but they haven't succeeded in it, and then it always naturally consolidates kind of to the biggest players that have the most resources, because there's no on-chain mechanism to really incentivize smaller validators, because you can't prove that a small validator is only run by one person. Like, and I think as long as we don't solve that problem, it will always tend to keep consolidating. Do you think it's a problem that can be solved? At some point, yeah, I think so.
I mean, I do. I think it could only be solved if you have some kind of identity off-chain, like, because otherwise you just, I mean, in a way, other people have exactly as you pointed out, right? They have tried to design proof-of-stake systems that are like, decentralized. I mean, look, Ethereum in a way, right? They're like, oh, they were 33, but like, and just you just run thousands of validators, tens of thousands of validators. It doesn't, or like others like, Polkadot or a bunch of others, right? They're like, oh, we have, every validator in the set earns the same rewards, and maybe at some point they assumed this was going to lead to, having, all these being different entities, but no, they just run a bunch of validators, right? I don't think there's any way to prevent this. You would have to really have some sort of, a bit like what the Solana Foundation does with their delegation program, right? Where they basically say like, okay, we're gonna do some kind of verification, make sure these are individual, organizations, and then we're gonna split the stake. Now, I think my understanding is actually in their case, they even think of getting rid of this or reducing this, right? Because they're kind of like, well, does that make a lot of sense? Because now there's a lot of validators whose only business is this Solana Foundation stake that they make a bunch of money on. Otherwise, no one cares about them. No one's heard of them. No one's staking with them. So I think they're starting to unstake from people who don't have other delegations, because they're like, this doesn't make, also, like, how does it really benefit the network?
Yeah.
Not very clear. Like, okay, you can tout some metric and say, oh, you have more validators, more decentralized, but it's kind of meaningless.
Yeah. And then you're basically just sort of like paying service providers to run your network.
Yeah.
Yeah. I think Larry from you guys know Larry and Dango, previously Delphi. So their network, they're like doing away with all of this, and they're just like validators are invoicing Dango and they're paying them to run the service.
Yeah, sure, but the issue is, I know there are like some people doing something like that, but then the issue is they will like, I don't know, pay something like what, like, 3K a month for something for a while, or like, some amount that, may be higher than the cost of just running the infrastructure, but is like nowhere near enough to actually, have a reasonable business, right? So that's not a future that, that's not a future that's gonna, allow people to organize great conferences like staking rewards. So just taking some.
Yeah, but but from decentralization perspective, is it hard to run the infrastructure there? Because like 3,000 euros a month or dollars a month, that might incentivize somebody to just run it in their home, right? It's still like a reasonably high amount. Of course, like a professional infrastructure provider that has like a huge team won't take this opportunity because there are just so many other opportunities. But there's also like a benefit in having like a plannable income each month when you have when you have like your cost and your invoice versus like some token that might moon in the future, right? This is also like a strategy that some validators are running, right? They are supporting early. They don't know what happens to the network in the hopes that it's like, they made their analysis and I think it's going to be big at some point. Basically like a VC, right? So it's just a different approach that offers the opportunity to run a plannable business. And I used to work at Telecom where we were also running a staking business, and plannability is extremely important also for like adoption of the more Web 2-ish players in the whole space, which some might like and others might not like, but just having like a volatile token every month where you don't know what you have in 6 months is very hard if you have to do like financial plans for over a whole year, versus when you have like something you can invoice, which is nice if you have like a company that is like listed. It actually isn't too bad of an approach.
Yeah, but I think here maybe like the issue is that in this example, you may have just like a network of kind of at-home semi-professional validators, and you'll never have the institutional type validators, the likes of Chorus, that are able to offer distribution to neobanks and asset.
Like it's in the end, you now make 30K. Well, even if you have Like, I mean, how many networks would you of that kind would you need to be able to support like a reasonable sized team that has, I don't know, does all the things that say like you need like a huge amount, like way more than they exist. And so I think it's not.
Yeah, but you're making the argument just for an institutional grade operator set. Do you need an institutional grade operator set with providers that have like 100 people teams for every network? Maybe you do not have a network that is meant for a neobank adoption, right? Maybe it's just like, maybe there are some other use cases.
Sure. Yeah, totally. It can be.
Of course, like there's, it's like about the decentralization, right? Of course, there's a cost. If you want to have like a super decentralized network, you cannot have like 100 institutional grade providers supporting it.
I mean, the issue with decentralization here is also like, what does it mean exactly, right? Because if this guy now says like, okay, I'm working with these 10 parties and, they write me an invoice and I pay them some dollars, like it's of course also very, very far from, the kind of decentralization that...
And then they all run it in heads now or something. Yeah. You mentioned telecom, and so there was a talk I think yesterday or a panel with someone from
telcos going in big in staking as well.
Yeah. So what's the play there?
Wait, what is that?
Telcos, like Deutsche Telekom,
Others as well.
telecommunication companies, and we actually have like a sponsor here as well, right? SC Bahrain and like Near Protocol is doing a lot. So
yeah, actually, I can take that one why telcos are moving, because actually telecom, I think we were the first in the space, and a lot of other telcos are now joining as well, following what Deutsche Telekom is doing. And basically the argument that we sold internally, so people were not, because we got actually challenged a lot internally with like crypto is a scam and stuff. But at the end of the day, from telco perspective, it's an infrastructure play, right? So you're an infrastructure provider for the internet, right? You're digging all the up the ground, putting all the cables in there. Then you're an infrastructure provider for mobile. And then what's the next big thing? These guys also need to position themselves for the future. It's like Web3, Internet of Ownership. Ownership, basically, it's a huge argument for blockchain. And then you want to be infrastructure provider for blockchain. It's still a very tiny business compared to the overall telco business, but you want to have a foot in the door in case it becomes bigger. And that's basically like an infrastructure play.
So what networks does Deutsche Telekom validate?
Or I'm not sure what they do, because they also, I think they had to cut some networks because of profitability. It's actually a problem. But definitely back when I was there, like Ethereum, I think Polkadot, and Celo actually, they had this like in the beginning a big focus on mobile, like connecting your wallet to like the mobile phone number. So that was also like strategic thing.
Chainlink was big for them.
Oh yeah, okay.
Chainlink is actually like it is. I think the biggest.
I mean, that makes sense, and I mean for Deutsche Telekom or any telco, who operate data centers and like have the infrastructure basically in house, it sort of makes sense. It's like a low lift to go run a couple of validators on like some servers running in in some data center that they have.
It's actually also from decentralization perspectives, I think a strong argument, because like you have the hyper decentralizer there, right? You have like your own internet cables, your own cloud. I think nobody else was on Open Telecom Cloud. So there's definitely an argument that these guys are also decentralizing, even though they are like these big players that are monopolizing everything. And on blockchain, that's gonna be hard.
And especially to have distribution as well. I think that's one of the key points. I mean, Deutsche Telekom and like other telco providers, like everyone using them on their phone. So it's a huge distribution and brand.
Yeah, right. If then they could of course like try to have a crypto wallet and stuff like that.
Exactly.
Yeah. And some telcos also have like, so for example in France, Orange also has a bank, right? And so there's sort of have different verticals in addition to the sort of telecom aspect. So that distribution can be sort of like internalized as well.
Yeah, I think it's very exciting. We probably see more of that, like networks willing to onboard for brand and distribution, and it's kind of a symbiotic relationship, I guess.
Symbiotic.
Talking about symbiotic.
Great transition. So we have about 10 minutes left. So yeah, since last time we talked, we did it together with Felix, and Symbiotic had not yet launched mainnet. So yeah, I guess at a high level, how excited are you about Symbiotic coming to the market? And more broadly, what do you think restaking looks like in a year from now? My perspective on restaking is that like the narrative has kind of deflated a little bit since last year, since Eigenlayer launched, and there's questions about like sustainability.
Yeah, I mean, I think there's they're changing their focus now, right? I guess from the positioning, they don't want to call it, like, no one wants to call it restaking anymore. I think even Eigenlayer and Babylon, like, everyone is kind of away from restaking because that narrative is kind of washed out now. And Symbiotic, I think I say universal staking now, and it kind of makes sense. I think this is like the use cases that those networks like Symbiotic have to unlock to really create sustainable yield, and it is coming as well with projects like this cap money, where you basically have a yielding stablecoin, and you stake into asset managers, and if they produce the target APY for the stablecoin, then they get rewards, and if they don't, then they get slashed. So it's really going more in the direction of just economic alignment between different actors online, and I think that's very exciting, like, for the staking space. Like, there's so much use cases that we haven't unlocked for staking in general yet. You look at staking from a first principles, it's just like putting capital, or like guaranteeing some sort of digital or economic work to be done and getting a guarantee for it. So you get a guarantee that someone gets a certain work done, whatever that is, generating a yield or whatever. And you do that in a trustless way, which is pretty fascinating, I think. And I believe there's like millions of use cases that are still totally underexplored in that direction. And I would love for these projects like Eigenlayer, Symbiotic, Babylon, everyone to unlock these use cases and help us to create a more efficient way of how we collaborate online and how we shape our economy.
What kind of use cases are you most excited about?
Yeah, I mean, for example, this like yield generation, I think this could be a big thing. Just getting guarantees that a certain yield is done, because then you have a real, you get a guarantee. That's almost like, and there's no risk, because if the yield is not generated, then they get slashed. So you not just trust the product when they claim they have whatever APY or something, but you're going to get it, and there's no risk of even losing your collateral. For example, if you have someone on the other hand, you could get slashed if your collateral or your yield doesn't sustain, basically.
Yeah, I mean, I think on a high level, Eigenlayer had a lot of expectations, right? A lot of hype. Then people deposited a lot of ETH into it in anticipation that, like, hey, we're going to make significant extra yield from it. Which at first was the points. And then there was the Eigenlayer airdrop. And, I think that seemed to have worked pretty well. But, that's over now, right? So now it's the Eigen pay some extra staking yield, right? Still, if you stake ETH. But that is like 0.6% right now. So let's say you make 3% from ETH staking, you make 0.6% from Eigen extra. LRTs were paying incentives, but I think all of those have run out. So you don't make anything from the LRT. And then the AVSs basically don't pay anything. And I think there's a very strong aversion from any AVS to pay anything. Because, like, if you could, let's say you compare to something like Solana. Solana pays staking rewards in Solana to people who hold Solana, right? They're Solana investors. most of these people like more Solana, right? They want to have Solana, right? So staking rewards doesn't necessarily mean people are going to sell anything, right? They may sell some for taxes, and there was the whole like economics debate around the Solana inflation proposal. But fundamentally, if you pay your staking rewards to people in your native assets who already hold your native assets, it's kind of like works pretty well. But if you pay your staking rewards to people who are just staking ETH and they want more ETH APY, like for sure they're going to sell all of it, right? Like, or the LRTs may even do it automatically on people's behalf. So I think there's going to be big aversion from AVSs to pay any rewards. So basically those are kind of like zero, right? So you have 3.6 now, roughly, if you're restaking ETH. The other thing is there's a huge amount of leverage in the system. So people mostly staking with LRTs. Most of the LRTs, I think something like 60 to 80% is deposited in Aave, because people will get stake ETH, get like easy ETH or something, or Etherify ETH, put it into Aave, borrow ETH, loop this, right? Of course, that also means that when you unwind this, the TVL, someone may be staking, 1 million, but then the TVL will go down by 10 million, or I don't know how much, but it's a lot, right? So I think, and that's also a little bit where you have, I think, one of the challenges around Eigenlayer, because for a long time they were like, hey, look, we have so much ETH in there. We're doing really well. We're killing it. But of course, that also means on the flip side, if the ETH balance going to come down, it's going to look really bad, right? And then that might depress the Eigenlayer price, which further reduces the yield people make, and more incentivizes people to unwind it. So my guess would be that, you're going to see the TVL for Eigenlayer come down a lot. And then in the end, for it to really make sense, and in the long run, right, you need the ABS yield. So this is the only thing that's kind of like real and sustainable. And yeah, I think that's going to be hard to get. Now, I think I guess Eigenlayer has gone in that direction too, but I think the symbiotic approach of people being able to stake their own tokens, I think is a bit more sustainable, right? So let's say if you like Ethena, and then you say you have a chain and people can stake ENA and USDE or something, and then like you probably want to incentivize that a lot more than you want to incentivize like ETH stake. Of course, that still then raises the question, okay, but what would a symbiotic token do, and why would it have any value? And so it still raises, a lot of questions remain. But yeah, I think you are going to see a big deflation of this whole restaking narrative, and I think people are going to be like, oh, this is dead. Now, don't think it necessarily is dead, right? In the long run, it makes some sense. It is pretty reasonable to say, hey, we want to have some economic value that's being secured, that's being used to secure one thing, to secure multiple things at the same time. And like, I think that kind of pattern is something that makes sense. So I think there's going to be something real there in the long run. But I think my guess would be restaking is going to have a, very hard time in the next, like 2 years at least.
And it's going to be hard to come back as well. That's what happens to all the projects when they launch with a high FTV, or with Eigenlayer maybe launch with a high TVL, so to say. Once this goes down, it creates a psychological kind of looks bearish. And it's really hard to come back from that. Instead of, if they didn't have much TVL but grew more organically, and maybe at this point it shouldn't have had so much TVL probably for.
Yeah, exactly. It becomes more of a liability, right? I mean, it looks fantastic, and okay, they could like raise at very high valuations and stuff like that, but like, I think it's something that then like hits you when it goes the other direction.
Yeah. Guys, I think we should button this up. Thank you so much. It's been fascinating. And yeah, congrats on another great event.
thank you for having us. It's been a pleasure.
Thanks.